Hello, everyone. Welcome back to another edition of the Weekend Charts. I'm your host, Charlie Bilello. It's been a crazy week in the markets. I'm going to take you through all of it. Before we begin, quick note, Creative Planning, my firm, is offering a free wealth path analysis to all Weekend Charts viewers. Just have to go to creativeplanning.com/Charlie, fill out the form, schedule a call or meeting with an advisor today, and you'll receive a portfolio checkup, a retirement roadmap, proactive tax strategies, and insurance and estate planning review. So definitely check that out, creativeplanning.com/Charlie. Creative Planning's in all 50 states, so we likely have a location near you. Over 300 billion in assets under management and advisement, and we're here to help. So what are we going to be talking about today? So much going on. It was really hard to fit everything in. I'm leaving out a bunch of stuff this week because it's simply too much. It would probably take a few hours to cover everything that's gone on this week. But number one, bad news is bad news again. We're going to be talking about the payroll report and the market's reaction. This is the biggest correction of the year now for the S&P 500. Markets are now saying there's a chance of a 50 basis point cut from the Fed in September. We'll dig into the numbers there. Bonds are actually acting like a hedge again, so a little change in behavior in the markets. Another ignominious debt milestone. We knew it was coming, but here we go. 35 trillion in national debt. Millennials and Zoomers are not leaving the nest. Why is that? I'll talk you through that. Q2 earnings update. We got more earnings this week. A lot of companies reporting: Microsoft, Meta, Amazon, and Apple. I'll dig through some of those reports. And we'll end, as we always do, with something positive. Has been a consistent theme over the past year. That's more affordable rents. So number one, bad news is bad news again. So that whole concept of bad news is good news because it means the Fed will be more likely to cut interest rates. That is not what's going on this week in the markets, and particularly after we got the weaker than expected payroll report. 114,000 jobs were added in July, well below the expectation, which was 180,000 jobs. And what we saw was the prior month actually being revised lower as well. But if we look at the streak in terms of jobs, it's still positive. 43 consecutive months now in terms of jobs growth for the U.S., but nobody seemed to care about this in terms of the market's reaction. What they really were looking at was the unemployment rate and the fact that it moved up to 4.3%, which is the highest we've seen since October 2021. And so the big question is, and I've been saying this for a number of months and adjusting the increase off of the cycle low, but the big question is this now signaling a recession is soon about to begin or already beginning? So if we're looking at the data in terms of history here, it's pretty overwhelming that when you have a 0.9% increase in the unemployment rate off of a cycle low, every single time except for March 2020 example, where it obviously came out of nowhere, we saw that huge spike in 1 month. Every single time we actually saw a recession beginning before we had this 0.9% increase. Now, we don't think that the economy was in a recession in Q2, so this time is already different, but market participants will have to really decide now, is this likely signaling a recession to come at some point in the next few months or the next year, which people really weren't thinking about, I think, weren't placing a high probability before we got this report. And if we look at why is the unemployment rate going up, even though we're still adding jobs, a number of people asking me that question. Well, it's simply the way it's calculated. If you lost your job and you stop looking for work, well, now you're out of the labor force and you're not counted in that unemployment calculation. So it seems to be more people are coming back into the labor force looking for work again. And until they get a job, they're considered to be unemployed. And so one way to look at this is simply looking at the labor force participation rate, which actually moved up in the month of July for prime age workers up to 84%. That's actually the highest we've seen since March 2001. So increased participation, and obviously those people coming back to the labor force, so far they haven't been able to find a job, so they're being counted as being unemployed. Now, is there other data suggesting that the labor market is cooling? What's the real-time data showing in terms of companies actually laying off workers and workers actually filing for unemployment? Well, for that, we have to look at jobless claims. And here's a chart showing you initial jobless claims, seasonally adjusted here, highest levels that we've seen in a year. So if this continues obviously to trend higher, it's more of a real-time indicator to say that yes, the labor market is turning south, and this has a high degree of correlation in terms of economic downturns. Pretty much every time you see an economic downturn, it's associated with an increase in initial jobless claims. And if we look at payroll growth, total payroll growth over the last year, we can clearly see here it's a cooling of the labor market. So for that labor market that was running so hot for a few years, well, it's been slowly cooling month after month, and now I'd say it's back to a state finally of normalcy here. 1.6% growth over the past year. That's the slowest growth rate since March 2021. If we look at the historical average, since this data it goes back, it's around 2%. So we're now below average growth. Definitely the labor market appears to be cooling. And a final sign of that would be just simply looking at hourly earnings, which of course have been running very, very hot for a few years, largely due to inflation, but also because of that tight labor market. Well, big move lower that we saw in the year over year change here. We're now looking at 3.6% hourly earnings increase over the past year. That's the slowest growth rate since May 2021. And the expectation is this will continue to trend lower in the coming months. So all of these signs pointing to a slower labor market. And the interesting thing was that the market did not react positively, saying, okay, this is increasing the odds of a cut, and maybe we even get 50 basis points of a cut. And as I'll talk about in a little bit, the market actually sold off and sold off big on this news. It's actually the biggest correction of the year so far. Not a huge correction, but you can see it in this chart here. This swing the past 2 days, we went from the post-Fed meeting euphoria. We got that Fed announcement signaling a rate cut in September. Powell kind of saying, as long as everything looks good, we're probably going to cut in September. Markets seem to like that. And just the 2 days after, a complete reversal after that period of time. And now we're all of a sudden in a over 6% drawdown for the S&P 500. That's the largest correction this year. So why are people saying that the market's going lower? I always have to look here to provide a reason. This is the only time I really look in terms of people explaining why the market is going down. You could always find a reason. It was a little bit tougher this time around. The past few years, a lot of the pullbacks have been due to, or at least this is what people ascribed it to, due to inflation fears or higher interest rates. This has been the opposite so far over the past month. I guess number one, before we got the unemployment data in terms of that rise in the unemployment rate, it was just the fact that earnings were lower than expectations. And I'll talk you through that in the later segment. But number two would have to be, I would say, recession fears. And that would be the decline that we've seen, that we're seeing today. So we'll see how deep this correction is. This is perfectly normal, of course. What was abnormal was that period of very low volatility that we saw, a long period without a 2% down day. We finally had that last week. We're on pace to have another one today. I'm recording this on Friday, and perfectly normal volatility, but we just haven't seen it in so long. It seems like very high volatility, and you could see the spike in the VIX today. Pretty wild. We'll see where it closes, but could be one of the biggest one-day moves we've seen in the VIX in history. We almost approached 30 at one point today. That was the highest that we've seen since the regional banking crisis, short-lived regional banking crisis in March of last year, March 2023. So what does this mean for market participants? Well, market participants should be getting more bullish as the market goes down. So it's the opposite of what's actually been taking place. I've been talking about elevated sentiment for weeks now in terms of a number of different indicators. Active managers were leveraged long. You have the individual investors in the AAI sentiment poll, highest bullishness we've seen all year. We're talking about the investors intelligence sentiment from newsletter writers, highest percentage of bullish we've seen in a long time. And now I suspect after this week, we'll see a big shift in all of those numbers next week. So what should you be thinking about with an elevated and a spiking VIX? You can think about there's more opportunity than there was before the VIX spiked. And historically, as I'm showing you in this chart, it's been better to buy the market at elevated VIX levels than at other periods of time. If you look at the highest 10% of VIX levels, so above 28.6, we got there today, and you look at S&P 500 forward returns over the next 1 year, 2 year, 3 years, 4 years, 5 years, on average, so this is obviously not every time, but on average, you tend to see better returns going forward. So fear creates opportunity in the market. Fear creates better levels in terms of valuations that you're buying in. It might feel painful to do so, but it's actually better as an investor to be buying when the VIX spikes. Now, is a VIX at 30 as high as it can go? Definitely not. Can certainly go much, much higher. We saw obviously during 2020 record levels in the VIX over 80. But when you get to 30, more often than not, that tends to be some type of level where there's a lot of fear in the market. And again, it was only a 6% pullback so far that's brought about this spike in the VIX. So a little bit unusual, I would say, that we got up to almost 30 with just a 6% pullback. Now, in terms of sentiment, what I'm going to be watching in the next few weeks is how much of an impact this has had, this pullback here, the 6% pullback has had on things like investors' intelligence, the percentage of bullish, on the active manager sentiment. What you want to see is this number come in. And we saw that back in April. Remember, we had that 5.9% pullback in April, and we saw almost immediately the percentage of bulls go crashing down. So you want to definitely see something similar here. There was simply too much optimism heading into this earnings season, and it seemed like the Magnificent Seven names could do no wrong. And as we'll talk about in the earnings section, the reaction to a lot of those earnings has been, well, it's a good number, but the expectations were so much higher that it's actually not being perceived as a good number. So the big question now, and this really wasn't on the table before the employment report, is the Fed now going to cut 50 basis points in September instead of 25 basis points? Before the employment report, it seems like the Fed was heading on that path of a 25 basis point cut. As I always do, I did the tomorrow's news today saying what the Fed would do, and they pretty much do what the market's expecting it to do every single time. So this isn't a huge forecast on my part, but the Fed did hold rates in July at that 5.25 to 5.5%, and they did send that signal of a 25 basis point cut in September. But now we got that unemployment rising, and a lot of people are saying that's going to be enough to push the Fed to 50 basis points. And if we look at the market's expectations, this can definitely change, but now we're at an 80% implied probability of a 50 basis point cut in September. A week ago, it was just 11%. Now these numbers are going to jump around a lot. We get another employment report before that September meeting, so that will obviously have a big impact as well. But for now, market seems to be saying increased chance the Fed will not only do 25, but will actually do 50. And what's interesting is, once again, those Fed projections, those economic forecasts, well, very quickly here, looking like they're going to be wrong once again. Their year-end projection for the unemployment rate, 4%. We're already at 4.3%. And they were looking at just 4.2% in 2025, 4.1% in 2026. So certainly they were not expecting the unemployment rate to go up meaningfully in the coming years, which is to suggest they're not projecting a recession whatsoever. And perhaps this data might change their opinion when they update their economic projections in September. It'll be interesting to see if they make some meaningful changes there. But in terms of the precedent here, if we look back, let's say the last 30 years or so, in terms of when the Fed starts a rate cutting cycle, well, do they start it with 25 basis points? They started with 50 basis points. I went back and looked at it. Let's first talk about the 25 basis point cuts in July 1995, September 1998, and August 2019. The Fed started each of those with 25 basis points, each of those rate cutting cycles. And what do those three have in common? Well, the economy wasn't in a recession, wasn't yet close to a recession when the Fed was doing those moves. And here are the two other data points that we have. January 2001 and September 2007, the Fed starts with a 50 basis point cut. Of course, in 2001, we saw a recession a few months after this rate cut. And in 2007, the expansion peaked at the end of that year. So if the Fed is saying we're heading into a recession, I think you could see a 50 basis point cut. If the Fed is saying, well, the expansion is going to continue, this is just a little bit of a slowdown here, then you're going to get 25 basis points. The difference that today versus any of these periods is we didn't have the same inflation coming off the same inflation threat that we have today. So none of these periods had the CPI spiking to 9% before the Fed started cutting interest rates. So still, yes, the balance has shifted. Clearly, the Fed is going to be more concerned now with the employment, maximum employment, than inflation. But it's not like inflation is at 1% or 0%. We're still at 3% in terms of CPI. So they'll have to weigh that going into the September meeting. Of course, we're going to get more CPI prints before that point. We're going to get more PCE inflation prints as well. That's the Fed's preferred measure of inflation, core PCE. And so if all of that data lines up, perhaps the Fed will go 50 basis points if they're fearing a recession. If not, I think they stick with 25 basis points. But a lot can happen between now and then. So let's not go crazy with these market expectations. Remember, many times they're often wrong and they might be getting a little bit ahead of themselves. In terms of other data points that might shift the Fed, if they're looking for things to pointing at some weakness, I've been talking about this for a while now, but the ISM manufacturing index continues to show weakness here below 50, which is the manufacturing economy contracting. And now it's been below 50 for 20 out of the last 21 months. That's a long period of time. In fact, with data going back to the 1940s, we've only seen that one other time. That was in 1989 to 1991. And of course, we had a recession in 90-91 during that period of time. So manufacturing, definitely weak. Definitely, if your Fed is looking for something to be concerned about, this would be another data point. And lastly, I would say in terms of the Fed, simply the number of developed country central banks that are cutting interest rates are starting to pile up here. We got the Bank of England joining the party this week, cutting interest rates for the first time since 2020. And you have the Czech Republic continuing to cut interest rates. Of course, Bank of Canada already cut rates. Eurozone already cut rates. The ECB, Sweden already cut rates. Switzerland already cut rates. So the Fed, if they cut in September, will be joining these other developed countries in terms of cutting interest rates. And I think that it is definitely planning on doing it at this point. Now, the one outlier here, well, of course, is the Bank of Japan, which hiked interest rates again this week. But if you look at their situation and why they did it, very different than these other areas. They're actually seeing higher inflation than they've seen in a long time, and their central bank rate still remains close to zero even after the interest rate hike. So really, they're talking about trying to save their currency, save the yen, which has been absolutely collapsing. And so far, that has been working. The yen's actually rallying significantly over the past few weeks. So looking at the real central bank rates, you can see here still very, very easy monetary policy coming out from the Bank of Japan. So perhaps they're not done in terms of normalizing interest rates. Perhaps they will have to hike rates even more. Okay, number 4, bonds are acting like a hedge again. This is really interesting because we haven't seen that bond portion of your portfolio act like a hedge during corrections in a long, long time. You probably have to go back to 2020 during that period of time to say that the bond market was actually rallying when the stock market was going down. And what we're seeing here today is kind of a flight to safety that we've seen a lot in the past 2 decades, and bonds are acting like a hedge again. Here's a chart of the 10-year Treasury yield actually moving below where it was when it started the year. So we started the year at 3.88%. And today on Friday, it went as low as 385 in terms of the 10-year. So below where it started the year, and that's caused a massive jump in the prices of bonds. Prices of bonds move inversely to interest rates. So interest rates going lower, good for the bond market. And with that 6% S&P pullback from the peak in July, we're now seeing the aggregate bond ETF up 2% over that period of time and at a 52-week high. So very different behavior from the bond market, more typical of the bond market of the past. And if we look over the past year, this is kind of interesting here. A lot of people were saying, well, don't invest in bonds, just stick to treasury bills, stick to cash. It's really interesting to see now bonds actually outperforming cash over the last year, up 6.2% versus 5.4% for cash. Obviously, a lot more volatility in the bond market, but this is kind of what we've been talking about in terms of the bond market likes rate cutting cycles. It likes recessionary fears. It likes inflation obviously coming down, and it likes interest rates going lower. So very different behavior in terms of the stock bond correlation than what we've seen over the past few years, which is the highest correlation on record between the S&P 500 and the broad bond market. And what we said is this is not likely to persist. And what it's likely to bring it down is a change in the fear of the market. So when you have that correction and the fear is rising interest rates, rising inflation, well, then the two are tied at the hip because interest rates are going up and the stock market is fearing that. They're fearing higher inflation and bonds are coming down. But today, very different type of correction. Inflation doesn't seem to be the primary fear anymore during this correction. It's actually more of a recessionary fear. And with that, you have interest rates coming down, obviously helping bonds, but hurting the stock market. So very interesting. Bonds acting like a hedge again. And that 40-party or 60-40 portfolio finally proving its worth after a few very, very difficult years. So number 5, another ignominious debt milestone. This is not something to be proud of. We have to talk about this because I think at some point it's going to be a big national issue. It's just not there yet today. 35 trillion in terms of national debt, hitting that milestone for the first time. We hit 34 trillion last December. Took a little bit longer than I expected, but here we are, 35 trillion. US national debt as a percentage of GDP, 31% in 1980, today 122%. Key stat I think to focus on here is just the huge, enormous expansion in the past 5 years, $13 trillion increase, 59% increase over the last 5 years. Why is this a problem? It only becomes a problem when you have the interest on that debt becoming untenable in terms of a percentage of GDP and just its absolute level starting to crowd out other spending. And for a long time, people said, well, there's nothing to worry about. And the interest expense is so low because interest rates were at zero. We don't have to worry about this. We're going to put that off and let's just keep borrowing and doing deficit spending. Today, very different story here. We're over $1 trillion in terms of the interest expense over the past year, but I don't think it's high enough yet to get a real concern. I don't see it as being the top few issues. I don't hear either candidate really talking about this as the number one, number two, or number three issue heading into the election. So I think it just simply has to get much worse before it gets better. And as a percentage of GDP, 3.8%, yes, that's the highest since the fourth quarter of 1998, but we've seen it higher before. So I don't think certainly it's going to get the attention from people until it's actually at a crisis level. So I think both of these numbers have to go higher. And we'll be talking about at some point in the next few months, we'll be talking about 36 trillion in terms of debt. We're adding this debt at a rapid pace. We're running deficit spending in an economic expansion over the past 4 years. And now we may be heading into recession. And the key question is, well, what are we going to do if we've been running these huge $2 trillion deficits during an expansion? What are we going to be doing in a recession? I think the answer is we're going to be borrowing even more money if that were to happen. So I think you're going to continue to see these milestones until it becomes a crisis. I'm going to talk about this with Peter Mallouk on the next Signal or Noise show that we do. So definitely tune in for that. Number 6, millennials and Zoomers not leaving the next nest. And why aren't they leaving? Number one would have to be the housing situation in the U.S. Here's the statistic here. 17% of 25 to 35 year olds in the U.S. are living with their parents. That's the highest percentage that we've seen since 1940. So after the Great Depression, when really it was out of necessity, people were living at home back then. Today, it's out of necessity, but for a different reason, because housing costs are simply so unaffordable so high. And if we look at the data in terms of the national home prices versus affordability, you can see that just the huge record divide here. Home prices up 6% over the past year, hitting all-time highs once again, and housing affordability remains at record lows. And it's really been across the board over the past 5 years. That huge money printing, that huge inflationary spike higher, well, lifted most asset prices, and housing was a prime example. And the Federal Reserve buying all those mortgage bonds, driving interest rates to artificially low levels, huge, big reason for this as well. And so we've seen in a lot of places 50, 60, 70% increases over the last 5 years in terms of home prices. And of course, we have mortgage rates at around 7% today versus 3% a few years ago. So that combination has led to the worst affordability that we've seen in history. And here's the key statistic for why people are staying at home longer. They simply can't afford it based on their income. So just like we saw during the 2000s housing bubble, we're seeing housing prices that are divorced from the reality of people's income. So almost throughout the entire history of the US housing market, you had home prices really being reflected based on people's income. So it was based on what you could actually afford. That is not the case today. We're seeing that you need 43.9% of your income in order to afford the median priced home for sale. And that's simply too high for most people. Most people are priced out. So yes, you can come in with cash. If you're a cash buyer, you can come in and buy a lower priced home in order to afford it. But other than that, if you have a median income in the US, you can't afford the median home. And so this is kind of a generational crisis. And the only way to solve it is for home prices to come down, or mortgage rates to come down, or incomes to go way up. So some combination of those few. What we've been saying is what we need more than anything else is more supply in the housing market. And we've got some good news on that front in the past few months. So hopefully that continues and this changes. But it's really a war between the Zoomers and the Millennials and the Boomers. The Boomers have benefited from these huge asset price expansion over the past decade in terms of home prices. If you haven't bought a home yet, you haven't benefited from that. And so will the Boomers be willing to allow prices to adjust back down? Will they allow it to the point where they're not going to be putting pressure on the government or the Federal Reserve to prop up home prices like they did after the last housing bubble? We'll see what happens there. But I suspect you're going to have a much weaker housing market in the next decade. So number 7, I want to run through the earnings that we've got in the past week, and a little bit worse than expected now coming into earnings season. S&P earnings growth is now only 3% year over year. That's notable because it's the slowest growth rate we've seen in a few years, and because prices, if we look at stock prices coming into earnings season, were running up well over 20% in the past year. So you have this huge multiple expansion. We've been talking about this. Entering earnings season, you had the highest multiple for the S&P 500 since 2000 in terms of price to peak earnings. And now we're seeing a little bit of a reversion to the mean here, a little bit of a multiple contraction, not obviously very much at all. We've only been a 6% pullback, but I think that's part of the reason for the market weakness is just expectations were so high entering earnings season, and companies simply haven't done as well as people were expecting. Now, the numbers on their face look very good, and we talked about this last week, but we got more seemingly good numbers from Microsoft this week, 15% increase year over year in terms of revenues. Net income was up 10% to 22 billion. It was the second highest quarter ever for net income. Meta had a pretty strong report, 22% year over year revenue growth. Net income up 73% year over year to 13.5 billion. That was a second quarter record for Meta. Unbelievable that Meta is able to produce this net income while it's still losing this massive amount of money on Reality Labs. I don't know how the person that's running this division within Meta is able to continue this. You're talking about $50 billion now in cumulative losses for the Reality Labs division since they started reporting this in 2020. But just a crazy number, a massive money loser for Meta. And I guess it's just such a money making machine that it could still pump out these profits overall. And talking about Amazon here, 10% increase year over year for Amazon. Net income more than doubled to 13.5 billion. It was its second highest quarter ever, and operating margins for Amazon almost hit 10% versus 5.7% last year. So on its face, again, seems like a good number. Apple up 5% in terms of revenue year over year, highest revenue growth quarter since Q3 2022. Apple's been struggling to grow its revenues over the past few years. We've been talking about that a lot. Maybe this is a sign of a turnaround. Net income increased 8% year over year to 21 billion. But if we look at the market reaction, I talked about this last week. This is what really counts in the last 3 weeks. What we've seen is all of these enormous 8 stocks, as I've called them, all of them trade lower in terms of earnings. And so after they reported earnings, we don't have NVIDIA yet, but it's down 18% over the past few weeks. And NVIDIA reports a little bit later than these other companies, but the rest of them, if you look at where they were before earnings season and where they are today, they're all trading lower. So even though the numbers seem to be pretty good, expectations were just so high. Somebody asked me about Amazon. It seems like such a good quarter. Why is the stock selling off? And I simply said, well, the stock was up 40% over the past year heading into earnings. So the expectation was extremely high. And so when that's the case, everything has to line up. Everything has to be perfect. And of course, that wasn't the case for a lot of these companies this quarter. So I want to end, as we always do, with something positive: more affordable rents. This is a great trend. Hopefully it continues. What we're seeing year over year in terms of the rental market, these are asking rents, national basis. A lot of people, when I post this chart, say, not here. They're not going down here where I live. Yes, that might be true. This is looking at the entire US, looking at the median rent. That's apartments that are renting right now versus a year ago. And they're down 0.8% in terms of that asking rent today. So another year over year decline. You could see that's been happening for well over a year now in terms of seeing those year over year declines. And the interesting thing is that rents, unlike home prices, are lower than where they were 2 years ago. So we actually had the peak in terms of the median monthly rent in the US, asking rent peak in 2022, around the time when inflation peaked. And since then, the nominal price is actually lower. And why that's good news for anyone looking for an apartment today is because while rents are lower today than they were 2 years ago, they're actually 2% lower. Not a huge decline, but lower than they were 2 years ago. Your income has likely gone up. If we look at just average hourly earnings in the US, up 8.5% over the last 2 years. So this is very good news. Obviously, the more it continues, the better it is. What we're seeing in terms of the rental market, very different in terms of the residential housing market. We have a lot of supply in terms of apartments. We had a lot of construction in terms of multifamily building and big apartment complexes in recent years. That's adding supply. That's leading to higher vacancy rates, and that's putting more pressure on landlords to lower their asking rents or just simply not raising them as much. So good news here. Hopefully this continues, more affordable rents. All right, we'll end it right there. Thanks everyone for joining me. Have a great weekend, everyone. If you're watching this on YouTube, hit that subscribe button for more content just like it, and I'll see you next time on the Week in Charts.